Today I'm talking with Oliver Beavers, the founder of Phosphor. It's a startup that's building technology to standardize and streamline the financing of infrastructure projects. In the finance world, we call this project finance, and it's really a critical piece if we want to build more next generation manufacturing and decentralized production facilities all over the globe. So what is project finance? Well, it's really just a loan to simplify it. And it's a big loan that you use to do things like build bridges and solar farms. And instead of using investor money who own part of your company, you actually take a loan out, which is called project finance, and you pay that loan back from the money that that project generates. The conversation gets a bit technical, but it's a critical topic we really have to address if we want to start making things again. In this conversation, we discuss why Oliver believes that despite there being an abundant amount of capital, very few projects are getting funded, why planning and storytelling happen to be the critical missing piece for project developers, and how technology like what he's building at Phosphor could help really solve these problems and reshape the future of financing real assets. Enjoy, and remember to go direct. All right, I'm here with Oliver Beavers. What's going on, my man?
Hey, not much, Jordan. How we doing?
Doing well, man. All right, so we're here today. We're going to nerd out a little bit about project finance and infrastructure. A lot of people are probably like, what the hell is project finance? So, I started my career in the investment banking world and also worked at a private equity fund. So I do have some scar tissue of extensive Excel modeling and financial modeling of all types of projects. So I'm sure, I think I understand pretty well some of the problems you're looking to solve. But we'll get into that. All right. So can you just explain to the audience what is infrastructure?
Sure. So to the general public, infrastructure probably has a little bit of a different definition, right? I think a lot of people might consider infrastructure to be toll roads or power plants and stuff like that. To the project developer and the project financier, infrastructure is an asset class. It is a financial product that's underpinned by a very large network of interdependent agreements and contracts with usually on average 15 or so different counterparties that all work together in some sort of way to create an investment profile for a pension or a large infra investor to say, all right, I can make a 20-year bet on the yield of this. And as such, I'm comfortable funding $100 million, $10 billion, right? In a way that is doesn't have recourse to the project developer's balance sheet. The asset itself, the project, is completely remote from that, and it's financed as a function of the agreements themselves. And that's probably one of the most important considerations for how you think about infrastructure, right? When you go and you see a solar project driving by the side of the road, solar project is probably underpinned by some sort of power offtake agreement, whether that's with a utility or, if it's on top of an industrial warehouse roof, that's maybe with an end customer. Maybe it's being sold into a program. But usually that agreement is going to be for, 10 to 20 years. It's going to be something that a bank can look at and say, all right, well, these guys have to pay if we produce power over that period of time. There is a clear story around the agreements for how that gets operated, by whom, and can I, as a bank, if this project defaults, swap out those operators who wipe down the panels to make sure that they're capturing the sun, all the way through to the actual capitalization of that project itself in a manner that does not expose the project as almost like its own package of value to the person and the sponsor who developed it in the first place, so that if I am a PE fund who owns that project, I can easily sell that off to another person if I'd like to shift it out of my portfolio. So in a lot of ways, it's almost like owning a bond, right? Infrastructure is a fixed income product by and large.
Okay.
That usually has, depending on what it is and how it's contracted, a lot of the stuff that I've ever really done has had a mezzanine risk type profile over 10 to 20 years of a project's life. So rabbit hole all the way up front, but that's,
we'll break it down. Don't worry.
The process of, the business of infrastructure development is taking a technology, surrounding it with all of those agreements and stories that you need across permitting in order to develop it into a manner that a third party can easily deploy $100 million into it and feel confident that they will actually meet their return requirements over a very long period of time.
Okay. Great. That's like I think the ending was a very clear way. But so I want to break each component that's really important, because before we kind of get into whatever direction we're going to go with this, it's important for the audience to understand kind of the different pieces so it's clear. So you use it. So we use the term, the term infrastructure in general. Most people think of toll roads, like you said, and airports, these things. And so in the case of, you use the case of like a solar park or a solar roof on a commercial building, and you use the term, okay, so someone's got there's the technology that, let's just use solar. It's an easy example. There's a technology that enables the solar power, and then there's the project. Use the term project developer. So can you just explain the very basic, the different parties in a solar project like that? You have the developer, you have the technology provider, and then you have someone who's financing it, right?
Sure. Yeah. So if I am, and like we can say this for solar, but this applies to industrial projects. This applies to like most of the stuff that you see in the built world that is not necessarily real estate, right?
Mm-hmm.
But a solar developer is not someone who produces solar panels, right? That's a manufacturing technology business. A solar developer is someone who goes out and identifies a piece of real estate and finds someone to buy power at a certain price, and then says, okay, well, I can put all of this together. Now I will buy this technology, the solar panels themselves, design and engineer it, and fund it based on the quality of that lease agreement, that revenue agreement, because at the end of the day, again, 20 years has to be discounted back to a value that justifies a margin up and over the cost to construct the project itself. And so the project, like if I'm a solar project developer, the project is really like a legal entity that holds the rights to use that technology or the ownership of that technology, the solar panels, and a whole bunch of different obligations to various counterparties to like sell power off, to operate it properly, etc. And so really the business of development is getting all of these agreements in place in an economical way. And in solar, usually the developer will sell that project off to a PE fund to finance the construction for a price. So I might originate the cost of this project, right? So the cost of building that solar project might cost me $2 million.
Okay.
If I look at the 20-year cash flows and I discount it back to a present value, and that's worth $3 million, then my profit as a developer is about $1 million up and over that cost when I go to sell that. And so that's sort of like how solar development works at a very high level. And it's why it's a really interesting business, because there are all sorts of different ways that you can use these small panels. You can put them in all sorts of different locations. You can come up with creative ways to sell that power off to someone. So long as you understand the basics of like what it takes for someone else to underwrite that, knowing that if a PE fund's going to buy that, that PE fund is then going to need to sell that story to their own capital partners to lever up the PE returns in the first place. And so the process of project development is like very risky. It's very path dependent because you have to get a lot of things right in order to get to that like bankable stage. But then once you do that and you've done so in a way where the agreements are, like really economical, it's a pretty incredible business.
Got it. So quick question for you. So as a developer, in this case, whether solar or it's mostly a lot of different infrastructure type projects. And you're saying they're typically a private equity fund's going to come in and finance that after you put all the pieces together, right? You're getting the land, you're getting the agreements, you're getting someone to buy that solar power in the future, which is the offtake agreement. But is it the same group that's financing the construction and then they're holding it for 20 years? Or do they leave and then someone else comes in, like a big pension fund or something, and holds it for 20 years?
It totally depends.
Okay.
Right.
Got it.
It completely depends on the PE fund. It depends on how much development risk they want to take. And what I mean by that is like, at one of the previous companies that I helped build, 38 Degrees North, our business was acquiring the rights to these development projects from, developers before they were construction ready. Right. So we would kind of lean in and take a lot more risk there. Those projects would get de-risked. We would fund the construction of them. But then once you actually get to permanent capitalization, that's really where like it becomes a stable asset that becomes refinanceable, and you can sort of like play all sorts of different cost of capital games because it's really a function of the quality of the revenue contracts and the agreements that sit beneath that. And if you've done that right, you can do a whole lot with a very small team because you're almost playing like a financial engineering game more than like a technology game. You're using someone else's technology to build this cash flowing asset, much in the same way that like a bank might use a piece of paper to originate a mortgage. You can pull them together for scale. And once you hit that scale, or once you hit a certain point of like how it's de-risked, you can definitely recapitalize it at a lower cost of capital and take an additional spread in terms of the actual value of like, your take of the project and the value that you accrue from it.
Sure. Yeah. I mean, it functions I mean, in that case, just like how real estate development commercial real estate development works, right? You're the developer, you come in, you buy the building, you maybe you improve the building, you bring the tenant in that might sign a long-term lease, and you sell it to an institutional investment fund or something. Okay, got it.
I would say that like for those who are real estate savvy, right? The big difference between infrastructure and like going the project finance route is that traditionally in real estate at the building level, there is like, if you're going to go take out a bunch of debt to finance a building, there's going to be recourse back to the GP or the sponsor's balance sheet, right? And so usually when you think about buildings, again, depends on the business model.
Sure.
Looking at if you're looking at like a value add type strategy, you go in, you buy something, you increase its value through like expanding rents, whatever you do, and then you refinance it, recap it, sell it off, and that's cool. Project development is a little bit different because you are assuming that like I, as a 2-person solar development shop, do not have a balance sheet to construct a $100 million solar project, right? And that's maybe an extreme example.
I understand.
But the way that you get around that is you make sure that the actual operating agreements are very long-term with very creditworthy off-takers, so that you can actually like raise all of that financing at the project level.
Yeah, with no recourse. No recourse meaning you're not guaranteeing it, so you don't have assets to secure it. Just for folks that aren't familiar.
Exactly.
Okay, cool. So, all right. So let's drill more specifically into project finance. It's something like I said, it's such an important topic today. I get very excited about next gen infrastructure, which we'll talk about. But so you made this example of where project finance is actually very different than, like I said, funding real estate. And would you just say it's just around the recourse component?
I mean, the ability to be non-recourse has a whole lot of features that you need to get someone comfortable with, right?
Yeah, sure.
Like there's, we can talk about next gen infrastructure, but like all of that assumes that someone like BlackRock can look at this and say, all right, I'm going to fund something that's going to cost 2 years to construct before it even like generates revenue. And then from there, I need to believe that it's going to produce X return over the 20 years that I'm baking into my DCF model right now. And so like, it's one thing to look at the model, but it's a whole other thing to create the whole story that goes into that model and that comfort to say, all right, yeah, here's 20 years of cash flows. Let's go do this. I, as someone who manages money for pensions, and am like risk averse, which most infrastructure investors are, need to feel very comfortable that this is going to be a stable yield in some way, shape, or form based on how I've underwritten.
Understood. So it's interesting. I want to get your perspective on this because this is what you do every day. I have found that there's actually just endless amounts of capital out there. There's no shortage of capital, especially as it comes to infrastructure. It's about deploying that capital and finding projects that fit their underwriting model that they're comfortable with. So can you explain to me, maybe I'm completely wrong, I don't know if you see a similar disconnect, but
you're about to touch on like, my big, like, oh, why isn't this different thing? Look, if you've ever like seen like climate tech startups or like
Sure.
these software plays, all of them are like, we need to finance $10 trillion. And so
Sure.
like we need to get the money. What a lot of people don't realize is like, there's 10 times more capital available in the market than there are a supply of properly developed projects, right? So we talked about that process of like going from zero to identifying the land, signing a lease, getting through permitting, getting the offtake, getting all of that stuff together. That takes an extraordinary amount of time. It's very high risk. And so when you actually start thinking about next gen infrastructure, right? Like technology companies that figure out how to like validate, a new way of producing a commodity, whether that's housing, whether that's power, whether that's baking soda, right? Like you also have to bet, if you're a venture investor betting on that, you have to bet that these startups know how to package these things like an institute, like a top-notch, like financial engineering shop.
Yeah, for sure.
Actually garner that investment, right? So what a lot of people don't realize is that like this skill set going from 0 to 1 on technology validation is profoundly different from like siting, permitting, developing, and capitalizing infrastructure projects and growing your company through non-recourse financings to support that CapEx spend and build up the actual revenues as an infra development company. And that's really like a disconnect that I see everywhere. It's like all of this stuff that you might see about like the missing middle, right? Or, this company doesn't want to finance this first of a kind project. An extraordinary amount of times that these projects fail and then these companies subsequently fail after that isn't actually the technology risk. It's the fact that they have no idea how to permit and like site and develop these projects in a manner that justifies a really large amount of third-party capital to make a 20-year bet. And so that's sort of like when we talk about the supply of capital and the supply of projects and matching them, there are far fewer people who know how to develop those projects properly than there are like funds to deploy capital into them. And it's because it's a knowledge problem, not necessarily a technology problem, but a skill problem that hasn't really like percolated throughout the market, whether it's with traditional infrastructure and like solar developers, or whether it's with deep technology companies or climate techs that like, have built something that is maybe very useful. Completing that full picture, right? The technology is a part of that. It unlocks economics, but you still need to create the complete picture that affords that type of like someone to invest in an infrastructure product that you've created.
Yeah, it's interesting. I have this conversation. I see it a lot. I actually, it's funny. A couple of years ago, I almost launched something in this space, but I, because of this, because I kept seeing it over and over again. But I just always tell people that it's like when it comes to first of a kind financing, which means for folks out there that don't know what that means basically if you have a technology that's enabling, like you have to deploy this technology for the first time. Let's just say it's a new type of energy storage or something like that into the physical world. That's called first of a kind financing. And obviously, when you do that, you want to take the least amount of dilutive capital or people take equity out of your business before just for building the physical project, which is what Oliver's getting at. But I just tell people right away, it's like the reality is like you have to do the first one with dilutive capital. And I mean, just generally, of course, there's exceptions to that rule, but I see so many people waste so much time on trying to get the first of a kind financing done, trying to do it in a non-dilutive way. And it's like, you have to do your proof of concept somehow. And unless maybe I'm wrong, are there people stepping up to the plate that are actually willing to take that risk on the first of a kind financing that you're seeing?
So I would push back on that really hard.
Okay, cool. Tell me, you're in it. I'm not in it. So
I would push back on that really, really hard. What I see a lot of as like a former professional infrastructure investor and now someone who co-develops these like projects and gets them financed, much more often than not, when people have to like raise all of that dilutive capital for their first of a kind or whatever, it's because they didn't actually start planning to develop the project properly like a year or two in advance, right? Don't get me wrong. Like nuclear fusion, yeah, you're going to have to like figure out some weird way to get that financed. But a lot of things that are, you get that, you prove a technology pilot, right? That is subscale to where you need it to be for commercial. So for example, if I have like a new like I don't know, carbon capture technology.
Yeah, exactly. It's a good perfect example.
Yeah, and my general business bet is that each project will capture 100,000 metric tons of carbon per year and utilize that somehow, right? Typically, the first pilot that you're going to do is going to be maybe 1,000 metric tons per year. You're proving the technology before it scales up, right? And so that's you can do that and you can operate that and you can get that up the TRL level, like the technology readiness, up to a point where someone can probably make a scale up bet on that.
So that's what's interesting to me. So I think I want to drill into it because I think there's two things here. There's one where it's an unproven technology and getting someone, even if you prove it out at the pilot scale, getting someone to take that bet on the scale up of the first of a kind versus obviously if you're a solar developer using existing technology that's already been proven out, that's a totally separate conversation, right?
Yeah.
So you're still finding though that it is more of a planning problem, that there's people out there or plenty of capital out there to finance those first of a kind concepts for groups that properly plan and prove it out at a pilot scale?
Well, first of all, I would say that probably the most detrimental word to this entire industry is first of a kind.
Okay. Tell me about that.
That is, you have never seen a bigger mismatch in alignment between someone who's going to raise venture, right? It's I've got this first of a kind, project, and ventures, VC's ooh, cool, new technology. And then you have to pass that asset on to an infrastructure investor who's first of a kind, folk, no, man, I'm out.
Totally.
No, you never, ever, ever, ever use that word. And so you see this fundraising process and this business process from people who have never done infrastructure professionally that just get everything wrong in the marketing process. They do not plan a good year or two out for how they're actually going to develop this project in a manner that can source infrastructure capital and enable an infrastructure investor to make that bet on them. A huge amount, I don't have exact numbers on this.
Sure.
Consistently, a lot of the time that is not a technology problem. It's a project development problem where they don't know how to package that properly. They don't communicate it properly. And as such, no one's going to justify the learnings that they should to make that bet. And usually, if you do this right, and if you're building a real business, you're going to have a pipeline of additional projects that sit behind that. You go to an infra fund, you say, look, we've proven the technology, right? This is the first commercial thing. First commercial, this is our second project, just to be clear, right?
Sure.
That's not for no first of a kind. Second project. And also there's a huge pipeline behind this that enables you as someone whose business is deploying capital to amortize your learnings on this first one over a much larger portfolio so that we can build a collaborative relationship. That's how you do this kind of business. Not, I've got this first of a kind project. Can you give me money for it? Because I think it'll be awesome, right? No,
you bring up a good thing.
I cannot.
It's a very interesting one.
I see that. I was about to say something I shouldn't have. That's stupidity.
Yeah, no. That it's interesting. I mean, it's funny. It's just an interesting one for me around. I'll use an example. If you've developed a novel kind of continuous chemistry process to make different APIs, different pharmaceutical ingredients or other molecules for cosmetics or something like that, right? So highly efficient, continuous process, green, the whole 9 yard, or whatever you're going to say. But, and you build a pilot plant, but then you got to scale it up to about, maybe 100x to build your first commercial plant. So what you're kind of telling me is if you have your pilot plant operating, it's more about how you would package this opportunity, because you're okay, this is the first molecule of many different molecules that we're going to make. And you think that typically typically you're going to have investors that are infrastructure investors that would be interested in actually taking on that risk of that first time scale up. Well,
for starters, you have to have a good technology and a proper project that has economics, right?
Of course.
That's table stakes.
Sure.
You see a lot of these climate tech startups we're just going to take a hit on the first 4 projects, And then no,
Totally.
we're completely reliant on tax credits for this and we don't generate money any other way. Nope. Wrong.
Yeah, for sure.
Do that either. But what I would say to that is sure, you've come up with this continuous chemistry process, right? And that's a really interesting process, but around that process is probably a whole lot of equipment that you're using that is already being used and it has warranty, right? A lot of the time in those types of technologies, the actual process itself is a small piece of it's a critical piece, but it's a small piece of the overall actual engineering of the project, right? And that's where a lot of communication loss happens because it's we've got this new technology. All right, well, is this an end? Is all of this new end to end? Or are you using amine systems to refine the carbon before it, whose technology has been around for 20 years and operates? Oh, okay, cool.
Sure.
So you look at these $50 million plants and it's all right, so of this $50 million plant, the actual technology innovation is maybe responsible for $4 or $5 million. And the rest is
I understand.
All of a sudden, still there, you have a storytelling problem, right? You need to work out how to focus on what the technology risk actually is and work with your third-party independent engineers who are going to have to sign off on this, right? No infra investor is going to invest in a technology like this without some third-party sign-off. And as a startup who's creating this technology, you have to be ahead of that. You have to be ahead of that and ensure that you are communicating this properly because a lot of times this stuff should justify not risk-free rate plus, not LIBOR plus 200 basis points type financing, but real non-dilutive infrastructure equity that has some sort of structured return and doesn't dilute the top co in a material way because there are real cash flows there. You should be able to be designing your business and your entire product strategy, if you are a technology company, to achieve that type of financing first. That is a business problem and it's a product problem. It's, that's how you solve that. You know what that criteria is. If you don't, figure it out. and then work backwards to that so that you've exhausted every other way possible other than diluting yourself for the first project. Maybe you finance 50% of it.
Sure.
Maybe you finance 7,
you take some worse terms on the first one because you have to or whatever.
There are ways to do this though, as long as you actually plan for it, know what you're doing, and manage that project development process properly.
Yep. Okay. No, that's very interesting insight. I mean, you're on the ground, so it's that was actually great to dig into. All right. So I have to read you something.
Sure. Go for it.
Because this is going to lead me into Phosphor and getting into the work that you do every day. Okay.
Totally.
I found this. I have to read it, so I'm going to be reading off of paper. Okay. Our thesis is that technology primitives adopted by financial engineers in the early 90s have forced the cost of information in these markets to remain frozen in the pre-internet era. By adopting primitives that make it technologically impossible to standardize information across markets, trillions of dollars in additional origination and market growth has prevented. So I assumed that was your thesis as it relates to Phosphor?
So that's my company, Phosphor.
Okay, so let's get into that. So that was a whole mouthful. So let's break it down.
Sure. Generally speaking, when you go look at large infra investing fund, right? You could look at it from a climate lens, Generate Capital. You could look at it from a big institutional lens, like Global Infrastructure Partners, or some of these more modern, technology focused investors. What you will see is that almost all of them do not focus on a single asset class, right?
It's just horizontal.
It's not just solar, it's renewables, right? Maybe that's wind, maybe that's right. And so I bring that up to describe how you develop projects as financial products for an infrastructure investor to capitalize in a lot of ways generalizes. The process that you go through to build that project company and to develop those revenues,
Yes.
ways that you think about risk allocation and how you generate revenue and how you produce the operating expenses and how you have carve outs that ensure that, like, if something goes wrong, you have backup plans, or a lender can have a backup plan, right? Which drives the creditworthiness of that project. There's a huge amount of that knowledge that has just never really been translated across parties. So I'm going to go a step further back, right? Our thesis is that, like, the cost of information, like right now, there are not a lot of people who know how to properly develop projects in a manner that unlocks project finance. And the reason for that is because the cost of information is so extraordinarily high.
Give me an example when you say cost of information is extremely high.
Sure. Every year, over $250 billion is spent on pre-construction costs for infrastructure. Like 9 times out of 10, those will be sunk costs. That is the cost of doing business in infrastructure development, right? Lawyers hate this one simple, love this one simple trick, right? The amount of money and time and effort that is spent trying to get a project to bankability, it's like development is like the venture stage element of a business, of like a project company. But where it's different from venture capital is that, like, this stuff is loosely templated. It should have been standardized.
For sure.
It has never had the opportunity to be standardized to make it a lot easier for that knowledge to percolate across the rest of the market. So the bet with Phosphor is that, like, right now, when information costs remain high, when these markets remain very opaque and nobody really knows how to do it, all of the value accrues to the investor. It accrues to the capital allocator
who's paying for it. Who
has their pick of the opportunities, right? Because there's so much yield to be had in, like, basic secrets that have never really, like, made it back. It's very profitable to be an investor. You're picking and selecting these different projects. And so the general bet, right, is that, like, if you look throughout financial history, right, like 1700, you have the Buttonwood Agreement that created standardization that enabled brokers on Wall Street to begin trading stocks in some sort of, like, across some standardized guidelines. Information costs go down because of standardization. Market explodes, right? It's Chicago Board of Exchange or Board of Trade. Everyone was, like, trying to figure out how to trade futures, but they couldn't. And the result of that is that, like, farming was a very difficult business because a farmer could not actually lock in a stable price through a futures agreement for their production. Chicago Board of Exchange standardized these futures contracts. All of a sudden, information costs dropped. The supply side of the market exploded. The most recent example of this, I think, like, before you get into crypto, which I don't quite know how to comment on, if I'm being honest.
Okay.
Like 1984, right? If you were the CEO of a bank, right, and you generate revenue by issuing loans out, right? Those loans have this floating market rate that gives you some exposure to risk in terms of, like, what your revenues are going to be that year. And so if you're a bank and you want to fix that risk, you go to another bank down the street and say, hey, you have appetite for risk. I want to pay you a fee in order for you to take on this floating interest rate. And so if this were like in the early mid 80s, you and I would have negotiated for a month or two. We would have come up with this 200-page document called an interest rate swap agreement, where you're taking my risk. And then, like, from 84 or 85 to 86, all of these banks, right? There weren't a lot of them. They came together and they're like, this is really dumb. This should not be rocket science, how we do this. And so what they did was, like, they all got in the same room. They're like, all right, of this 200-page agreement, we can actually eliminate, like, standardize away about 90 pages, like 190 pages of this, right? Like, overnight, reducing the cost of information by, like, over, like, 95%. From that point on, interest rate swaps were, like, forget the exact number, like a $30 to $40 billion notional value, notional market at that time. Over 30 years, they just inflected up into the backbone of the global economy. I mean, those markets are like 60, 70 trillion dollars now.
Just
If
exploded.
not more. And so time and time again, you see that what happens is when the cost of information goes down through standardization, the value begins to accrue more and more to the originator, the developer of these projects, because you can predictably like reproduce these projects, these assets in a manner that you know will get funding. And so the business of like how the allocator thinks about it is like, actually, we need to make a bet on a platform based on an origination advantage instead of like a project advantage that we have some sort of, like secret on. And so Phosphor bet here is that like, our thesis is that none of the information primitives in the models and the legal agreements specifically have ever really been represented in a manner that enables that cost of information to drop. And so what you sort of see this like when you go back to like 1985, right? If it was 1985 and I was a developer or like really a bank trying to model out an infrastructure project, I would have built all of this logic in COBOL. I would have done it in a mainframe computer. And at 86, 87, Excel gets invented and adopted en masse, right? Which opened up a lot of opportunity, right?
Sure.
Like Excel was at the time a pretty extraordinary piece of technology because it enabled a lot of people to take these programming concepts and represent visually to connect things together. But I don't think anyone really like has appreciated how that open source would ever be a thing, right? So the general thesis for us is like financial engineering and software engineering look in concept like very similar. I write code. It's deterministic logic that is testable in some sort of way, shape, or form. Except with code, I can open source it. I can version it. You and I can communicate from the same repo and build on top of that knowledge. Finance's adoption of Excel in the late 80s adopted a language that makes it fundamentally impossible to do that.
Sure, right.
And so it's very like when you think about the process here, right? The model is not the largest source of information in these deals. So it's a weird thing to hone in on. But when every single part of these transactions begins with a marketing model, right? If I'm a developer trying to send you an investment, the first thing you're going to look at is the model. That really represents the commercial structure of the thing that you're investing in. And the agreements are then codified from that point on.
Right.
So it is impossible to actually standardize any of these agreements without figuring out how to do that at a much tighter level of abstraction, which is the model. And so coming back to the cost of information, right? Financial engineering and software engineering diverged on that cost curve because in the early 90s, Linux kind of like initiated the open source movement. And eventually that turned into GitHub, where like all of a sudden you had software engineering that was a very technical skill, right? Become accessible to your 15-year-old brother who like wants to build a website because they can go and access standard information abstractions. They can read and understand them easily. And they can work against them. And there's a process for managing that, implementing that into a broader system, etc. It has never existed in finance, but the reason you can do that in software is because you can directly read that logic, and the logic is decoupled from the execution. And so in the age of LLMs, that facet becomes a lot more important. All of a sudden, the cost of knowledge for software engineering declines even further. Now you have a 4-year-old that can use an LLM to produce up an application. And also, but like in order to do that, you have to have a language that is change trackable to manage all of that. And so our opportunity and our bet with Phosphor is that if we rebuild these languages for the models and the contracts from scratch, completely like rebuild the primitives, we're granted an opportunity to transform the cost of information in these markets by enabling you and I to communicate across the same abstractions in manners that have been validated and financed by third parties such that like you don't need to go through all of this extensive process there is a central point for information for how to do this stuff. That information can be used by a developer to easily pass it through a system of development, through financing, through third-party financing, in a very consistent manner that enables these whole markets to just kind of unlock in ways that I don't think anybody's really thought through except for me.
So just to make sure I'm clear, so who is using? So the principal user of this is the developer.
Right now, it's us.
You're dog fooding your own product, right?
Yeah, totally. We're dog fooding that as like co-developers of new technology companies who need to figure out that pivot from like technology company to project company, producing these assets that enable them to inflect the next level of growth without actually requiring venture to fund that.
Got it. Okay, so you, as right now at the beginning, you are the co-developer of the projects. You're kind of using these projects as a way to build your generalized model for infrastructure development, for project financing for infrastructure development.
Totally. So right now we are largely a services company.
Okay.
What we offer is a dramatically reduced risk of failing to finance a project.
Yep. Got it.
It's a huge amount of like expertise and know-how and like network and credibility. But from there, with what we're building with Phosphor, especially in the age of LLMs, our venture and like technology bet is that we can actually end-to-end automate almost the entirety of the project development process and take stuff that would take us as experts months and do that in almost real time.
And let me ask you this. So obviously a lot of this has to do with your knowledge as a project developer or co-developer. I assume if you're doing this, you're pulling a lot of data and a lot of information from agreements, all types of infrastructure project agreements, if you're going to create a generalized model here. So are you using publicly available data?
No. So we're not a data company, right? What we've done is we've figured out a way to technologically represent the schemas of the information in contracts, in a manner that enables LLMs to process them in a factual way. And that's a really key point. Right now, most of the legal technology that you see, right, it's oriented through this process called RAG, which is retrieval augmented generation. It's like using LLMs to identify areas of an agreement and like surface that as it contextualizes it with, transformer models. And I don't know how deep down the AI rabbit hole I need to go here, but the problem with that is that if you're trying to use AI against 2,000 pages of like interlinked agreements that in an infrastructure project, you expose yourself to a large degree of potential hallucination in the models.
Yes, I get it.
And inconsistency. And so what we realized needed to happen was we needed a way to, instead of trying to use LLMs to extract meaning from contracts, figure out how to just translate them into a consistent deterministic like language that then does not expose you to that kind of like information problem.
I understand. And in what you're saying at the beginning, what you were saying is really your source of truth at the project level, which determines everything else, is the actual model. It is the cash flows. It is the number.
It's the model. It's how that model is represented in agreements. It's the process around that model. Usually, so if I'm a PE fund, right? If I'm going to buy a solar project, I'm going to have like 10 different models going at a time. Each of them are going to have slightly different information. Right. So if you're a developer, you're marketing me a project, right? You have assumptions that might be a little bit aggressive that I need to bat down, but maybe I don't communicate that back to you. Right. And then me as the PE fund, I'm going to do the same thing to my lenders and say, hey, this is like what I want you to assume in order to size this amount of debt. Right. So all of a sudden you have this extraordinarily difficult coordination problem. And so much of finance is just coordinating processes and information and documents around these different like network workflows.
I understand.
And the problem with that is that if I am a small PE fund, you're a developer, you and I are going to have a model that probably says the same thing, but might calculate the outputs using different languages, right? And then the bank might too. And when you have that inconsistency in like what the terms are, what the modeling logic is, and how you get to it, like it becomes impossible to gain any sort of efficiency.
Mm-hmm.
It becomes impossible to connect things together even, so that you don't even need to like, shift off of the technology platform. And so like taking a step back for the technology inclined like viewers of your podcast, right? What we've done with finance is we've represented it much in the same way that you'd work with code. There is an editor that produces outputs. There is Git, which we've had to build from scratch.
Okay.
Based on the languages that we've built from scratch and the compiled output that we've had to build, the editor we built from scratch too, where we've effectively taken every single layer of the software development ecosystem,
okay,
and rebuilt all of it into a single product for finance. And what that lets you do across both the model and the docs and the contracts is it lets you manage end-to-end development and underwriting workflows all from a single product that hosts all of that context at once. And only when you can achieve that do you actually have an opportunity to do something truly meaningful with LLMs in the first place.
I understand. When are you going to be releasing it to third parties to use it? So it's not going to be internal anymore.
I don't know yet.
Soon? Or you don't know?
Maybe, like 6 months from now, we're working through live, like how and when to do that, because we've come to a point where it is very clearly going to augment like the development side of our business to such a degree that, it's almost a little bit of an advantage. And so like ultimately, right, when we work with customers, I didn't build Phosphor to like sell software.
I understand.
Right. I did it to like put projects in the ground and like create outcomes. And how we go about doing that, I think we're just trying to be really thoughtful about, because it does afford us as a team an ability to do like literally 100 times more work than an expert development team otherwise would of the same size. And that's pretty nuts.
No, that's pretty cool.
That's nuts.
I think what's interesting, what I appreciate with that, and we can kind of wrap up here in a minute, but what's interesting, what I loved hearing you say is the goal is just to do more projects, right? Like that's the goal. How do you streamline and do more projects? Not about selling more software. And I'm glad to hear you say that, because it's like when it comes from the perspective of decentralized production and this next gen infrastructure to make a cleaner, greener future for everyone, right? It's, there's a lot of work to be done in the space.
I would say that there's definitely going to be a point where it is available for broader access. But if you had invented a programming language and Git and an editor all at once, but nobody had ever built like React, nobody created SQL, right? Nobody created these fundamental abstractions that you use in software, then like, is it that useful, right? A lot of what we're doing is working, like you build the technology first, and you build the Solar abstractions on top of that, and like works through that and get that kind of tested out. And from there, especially once it's like underwritten with partners the first time, that's when it becomes an opportunity to reduce those knowledge costs, because our advantage is that we can actually like develop and finance projects. We're not just a software company. And so when we can set that mark and then share that with people so that there's a complete profile that someone else has looked at for a market, that's how I think you actually drop the cost of information in these markets in a material way, right? Actually getting it proven out in some way, shape, or form all across the whole like set of knowledge, as opposed to just here's some software that you can use to model things out.
Yep, I get it. Cool, man. Oh, listen, a question I'd like to ask as we wrap up, because it's also good knowledge sharing for the listeners. But what's the last podcast you listened to, or book you read, either or, whatever the last thing has been?
I think I'm blanking on the title a little bit. I think it's The Masters of Air, The Alchemy of Air.
Alchemy of Air, okay. By who?
About the creation of the Haber-Bosch process for producing ammonia, and how good intentions went a bit awry as created this really unique chemical. It reads like a fiction book. It's fantastic. And it's also really kind of like a salient one for, all of the sort of new technology that's coming online, even around ammonia itself. It's a pretty fantastic one.
Cool. Awesome, man. Well, hey, Oliver, I appreciate it. Tell people where they can find you or Phosphor online, or the best way to reach out.
Phosphor.co is the website. It's a little bit old. Otherwise, LinkedIn, Oliver Beavers. Love to connect with everyone. And Jordan, thanks so much for the time.
Thanks, my man. Look forward to following the progress.
All right. Bye-bye.